Oh, good morning, Stephen. Happy New Year to you. I think that's the key question. Obviously, as we enter 2022, when we look ahead, there are lots of really obvious risks. We could all list them. It's COVID, it's interest rates, it's insurance, it's inflation, things of that nature. The question is, how do we then address those risks? And there's a real temptation here, I think, as we enter the new year, and that's to be overconfident in our predictions, either to decide that valuation doesn't matter anymore and just to go with the flow of the leading companies that have been doing so well over the last few years, or to take a really strong view, as you say, that it's going to be difficult to make money this year, that we need to pull back, to be really defensive. And again, either of those is likely to be a mistake from an investor point of view. Taking too strong a view can leave us in the wrong place as we go through what is likely to be an uncertain period, as we all know.
Yeah, you look really cautious to me when I look at your conviction on everything from equities to fixed income to listed property. You're at best medium, at worst low on conviction. Actually, that's not true. Actually, medium to high on UK equities. I note there as well, and Germany as well. Are you just giving yourself powder for when you think there might well be a downtick at some stage, more volatility, a downtick, and then perhaps reinforce your conviction?
Well, that's absolutely right, that we only tend to get really excited about investment opportunities when there's blood on the streets, when everyone else is running for cover. And so it's not surprising that we don't have very many high convictions at the moment, because valuations aren't typically favourable across most of the world. As you say, that the UK is a bit of a high spot. There's some interesting opportunities in the emerging markets, but generally things look pretty expensive. But I think, again, the key is not to go in completely the opposite direction, not to position for a crash, as we know there's plenty of good things going on as well as we emerge from the pandemic. And there seems to be some better news about the way that the governments are treating the pandemic and the impact that's going to have on the economy. So important not to take too strong a negative perspective. But I think as we go into 2022, the focus needs to be on the robustness of portfolios. When you have a very narrow opportunity set, a narrow list of things that are attractive, then the danger is that you focus too much on those and that you get caught by something unexpected. And so thinking about all the different things that could affect a portfolio, both good and bad, is going to be key. Don't get carried away. Focus on how robust your portfolio is to a range of possible outcomes.
Actually raised my interest in something you said straight at the top there, that valuations are not particularly attractive. But valuations, as we know, frustratingly for many people who look at a lot of the normal metrics for equities, valuations haven't been attractive for a very long time and have become a little bit more extreme now as well. So I know valuations don't matter in the short term. They only matter in the medium to longer term to the market as well. Are we entering a period now when valuations will matter again?
Well, I think, again, you're right. Investment is always about the long term, and over the long term, valuations do matter. And of course, as we look ahead at 2022, then we need to think probabilistically. The higher the valuations are, the less likely they are that they're going to go much higher. There could be some increase in valuations. Always, we can't discount momentum in markets, but the more expensive stocks are, the less likely they are to get more expensive relative to their fundamentals. So you're absolutely right. It's likely this year that the valuation is going to come more into the foreground as people realize quite how positive the expectations are that are built into some of these stocks, particularly in the US, particularly in technology. We've talked about that before. So there's certainly investors need to focus on valuation. But when you see something that's very likely, like valuations coming back into the foreground, it is really tempting to take too much of a short-term view and decide the market's going to crash and that you need to pull in your horns. We may not see that in 22. We may actually see another strong market. And so focus on valuations, always focus on valuations, but don't assume that they're going to revert very quickly. It might take a while for them to revert, particularly when there's momentum behind the market coming out of this pandemic. So try and not to focus too much on what's going to happen over the next weeks and months. Focus longer term, focus on valuations, but I would caution against overconfidence at this point in the year.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.